Hello, everybody, and welcome to the Like a Tortoise portfolio. In what a day this one is. I'm recording this on February 11th, so I'll be posting this video a bit late today. It's already late, right? Because I typically post them early in the afternoon or even morning. But bear with me as I explain to you why that is. We just bought Constellation Software, and I've been focusing on the full investment case. So I've been working very hard to put together that investment case for our partners and clients. And so it took me a little longer than expected. I've been working on this for the last several days, doing our own due diligence. And here we go. I only had time to do this recording today, but I'm very excited with this new position. And it's been so you just can't do this with many investment strategies. And just to give you guys context, we started the Like a Tortoise portfolio a little over 2 years now, and we never ever sold a single share. So other than the transactions that of course we had to execute to buy the shares in the first place, we never sold a single share in the portfolio. And the main reason is that, number one, most of the companies haven't yet reached our intrinsic value, level, right? And some of them already have, like just a few of them already have achieved that value, but we do believe that the price hasn't really detached significantly from the fundamentals on the way up. And because they are really high quality companies, we decided to hold on to them. Okay, one of them being, for example, Ulta Beauty, which unfortunately I didn't get to buy more because the stock just ran away from me. But this new addition makes me feel very excited. And this is one of those companies, guys. I mean, look, there is no point in me telling you I told you so, because that's not what we're here for. But Constellation Software is a company that throughout its 30-year history never ever experienced a 50% drawdown, ever, until very recently, on the back of AI disruption fears and the leadership transition, right? Because the CEO of this company, Mark Leonard, is stepping down. Right, he's no longer the CEO of the company. He's going to remain on the board of directors, but he just passed the baton to Mark, to another Mark, who has been with the company for the last 30 years or so, right? So from the very beginning. So the company is going to be in good hands, in my opinion. But I think the main reason for the sell-off has to do with AI disruption fears, because of course we are seeing massive selling pressure across the board. In the software companies have come down sharply. And so let's just give you everything that you need to know. This is also the reason this is going to be a special episode is, number one, it's going to take longer than usual, okay? But because I will be delving deeper into the full investment case, okay? So I think if you guys are interested in the due diligence that I always do before investing in a company, and that's when most of the work will happens, right? Then this is definitely one of the best videos, if not the best video that I will ever put out. Hopefully I will do this more often, of course, but certainly the best video until now, because it's going to be jam-packed with important investment insights. All right, so long story short, Constellation Software is a serial acquirer, and this company came on my radar about 2 to 3 years ago. Because I know, right, because I'm an avid student of history, I know, as you can see right here, that companies, where is this serial acquirers? Here we go. You can see that serial acquirers historically, and this research goes back all the way down to 2004, as you can see right here. You can see how much serial acquirers typically tend to outperform over time. All right. So, this was the first thing that caught my attention. Okay, so serial acquirers outperform over time. Is this interesting to me? And then I started reading more about the business model of many of them, and of course, it was just a matter of time before I arrived Before I came I stumbled upon Constellation Software because, of course, it's the best. You guys know that I always want the number one or number two or three in their respective industries. Because if I'm looking for a company with a wide competitive advantage, according to my own research, then typically it will always be one, two, or three in the respective industries. And sure enough, Constellation Software is not number two, number three, but number one serial acquirer in the world. All right. And the performance, the track record speaks for itself. And I believe that this is nothing structural. I believe what we are seeing right now, this nasty sell-off, is temporary because it's overblown. I think AI fears are overblown. I think so it is true that certain companies are going to be more impacted than others. However, as we will discuss throughout the video, Constellation Software is focusing on the vertical software market, and I do believe this market is less susceptible to disruption compared to the horizontal software space, where you have, for example, companies like Salesforce and many other names. Okay, because they software, right, it's horizontal because it can be applied across different industries, whereas in vertical software companies, what they sell, so the software is very niche, and in my opinion it's less prone to disruption. Okay, we will discuss more, but you can see that with this sell-off, the stock is down what, about 60% from its all-time highs, right? This never happened in the company history. Once again, you can see right here that this was my average price per share, as you can see. So it's right where the blue line is at, as you can see, which means I'm already in the water. But you guys, I mean, you know that I'm completely fine with that because I'm not in the business of predicting the markets over the short term. I am in the business of making sound investment decisions that are going to create a lot of nice returns over the long term, right? Cool. So, and the reason you see the dark line right here is because if this thing just decides to continue to sell off, I might add at these levels right here. And look, it's just what it is. And I mean, so many quality investors were telling me that Constellation Software has never traded cheap. You're never going to be buying with that margin of safety that you want. Boom. So those of you who have been buying the stock around the 2024 levels or 2025, I mean, believing that this, just because the company is spectacular, it's never going to face any significant headwinds or anything, but right, sentiment will never going to be impaired. Here we are in a 60% drawdown. This means that like a tortoise is the way to go. Okay, provided the story has not changed, because I wouldn't have bought it if I understood, if after my own due diligence, I come to the realization that yes, the story has changed. AI is going to significantly impact this company, and so the nasty sell-off is warranted. And of course, that was not my conclusion. Okay, so this is then the seventh company in the Leica Tortoise portfolio. I will not own more than 8 companies because I'm not comfortable. I'm not comfortable beyond that because it's difficult for me to track with them, and I like to understand the businesses that I own very well. And this is what we are going to talk today. Many times you guys tell me to analyze a company, and again, there is only so much that I can cover because I don't know the business. And what I will show you today explains exactly how difficult. Well, I mean, it's time consuming, right? I mean, if you want excess returns, outsized returns over time, you have to do the work. You have to put in some time and work to analyzing a business and determine what is the moat, what is the competitive landscape looks like, what is the growth prospects going forward, right? In all of those things. And that takes some time commitment. And so in our videos, I typically cover only the financial statements, right? And typically, if the company does have a moat, then you will see that in the numbers, especially the numbers that we like to keep a close eye on. That said, again, I mean, I don't discuss competition in the videos, right? The industry, all of those things. But this is what we will do today. So you can see that I just created the full deep dive, a full deep dive into this business. And again, this is a report that I will make available only for partners and clients. But this guys, as you can see right here, this is a 44-page report. And I answer all of these questions, right? I'm very picky. I like to understand the company very well. I go through each and every single one of these questions, right? Table of contents. Number one, do I understand the business model? If I don't understand the business model, then I will not invest in it. It's an easy pass. Is management capable? Do I think management has done a good job while at this company going back many years? Or if they are new in the company, what is the track record, right? I mean, what did they do? What did they do in the past? So, Alan, do they have skin in the game? Right? Those are the things that I want to understand. The culture of the company, are employees happy, and so on and forth. Does the company have a sustainable competitive advantage? What's the moat? What are the competitive advantages? Is it switching costs, network effect? Is it are they the lowest cost provider in their respective sector industry, right? Do they have a monopoly? Do they operate in a oligopoly, right? So what is their moat? We have to understand that, because ultimately we want them we want that moat to be ideally strengthened over time, right? And certainly not being impaired, disrupted. So then, what are the main risks for the company? Every single investment carries a certain level of risk, right? You can mitigate that risk by buying a high quality business, right? And by paying by paying a price that has already a significant margin of safety built in, right? That's it. That said, still, all investments carry some degree of risk. And this is what we are trying to determine right here. Does the company have a healthy balance sheet? The main reason most companies go bankrupt is because they have a terrible, I was about to say shitty, but yeah, so they have a shitty balance sheet, right? They carry a lot of debt. I don't do that, and I will walk you through my criteria in this section. Does the company need a lot of capital to operate? I don't like businesses that are capital intensive, right? So, and that's part of the reason why I stay away from industries like commodities, precious metals, airlines, and also companies that operate in very cyclical sectors. I stay away from that because all of that creates inconsistency in the numbers, which makes the investment unpredictable, right? Is the company a great capital allocator? Here is where we are then delving deeper into my favorite metrics, namely ROIC, return on invested capital. How efficiently can the company generate so how well can the company turn profits, right, from its invested capital? Good. So how profitable is the company? We're going to check margins, cash conversion ratio, all of those metrics that I love analyzing. Does the company use a lot of stock-based compensation? If so, that's a red flag. We want our interests to be fully aligned. Did the company grow at attractive rates in the past? If you are buying a turnaround company, I answer this question, and preferably the company would have created a lot of shareholder value in the past, right? When you factor in share price appreciation and, of course, dividends reinvested. But many companies that I own have been terrible, right? Because they crashed substantially, and I'm buying turnarounds, right? So here we go. Does the future look bright? What are analysts' assumptions about the future growth prospects, right? Is it good? Are they projecting company to grow attractively in the next 3, 5 years? I mean, so I want to know that. Does the company trade at a fair valuation? Most of the time, the company may check all of these of my criteria, but then it just happens to be expensive by my standards. In which case, I just put it on the watch list. And so yeah, it's what it is. Last but not least, should we invest in the company? And you already know that's what I did. Okay, guys, so do I understand the business model? This is the first thing. In how do I answer this? Oh my God, there is so much thing that you can get your hands on from annual reports to quarterly reports, but certainly annual reports, to great Substack work that has been put out by other great analysts and investors, right? And also you can already start doing some research using ChatGPT or Google Gemini, but then you have to corroborate, right? Corroborate what ChatGPT is giving you. You have to back that up with data to make sure that it's not misleading, right? And that's how I started putting together my findings, right? So I just look at different resources and put everything together in a word page. Mark Leonard, as you can see, was the founder and CEO. He worked almost 11 years in venture capital. During that time, he learned firsthand that venture capital dismissed small, niche, yet essential businesses. What's more, these were very profitable, had strong moats, and one could buy them at a liquidity discount since their total addressable market was too small. He then decided to own many of them through a holding company called Constellation Software, which IPO'd in 2006. And pay attention, fast forward to today, Constellation has achieved a compounded annual growth rate of 30%, having never experienced a drop of 40% or more, as I was telling you, until now. And sure enough, right now the stock is down about 60%. This makes CSU the best serial acquirer in the world, for sure. And as you can see below, and look at that, this was a screenshot that I took. When did I take that? This was not today. Yeah, look at the price. It was higher than it is today because the stock today is already down about 6%, right? And so I took this yesterday or before yesterday. I don't really remember. But anyway, I mean, look at this nasty sell-off, right? As you can see, Constellation is now experiencing its worst drawdown ever, a 56% decline at the time of writing, and now it's about 60. Okay? So, Constellation buys what's called vertical market software companies, whose software is designed specifically to meet customer needs, both in the public and private sectors. The software is mission critical, but typically accounts for less than 1% of customers' costs. Right? What do I mean by that? Guys, they need the software to run their operations. If without the software, right, the business cannot function, and that creates a lot of this creates high switching costs, right? A lot of stickiness among customers, which is something that we analyze when we explore when we discuss the competitive advantages. Using a combination of proprietary software and market expertise, SEO provide software solutions designed to enable their customers to boost productivity, operate more cost effectively, increase sales, and improve customer service and satisfaction. The VMS sector boasts attractive economics that SEO management teams have a deep understanding of. That's part of the reason why they've always stayed within this circle of competence. They only acquire vertical software market companies. And the reason is it's within their circle of competence. As the company grows larger, they are exploring, perhaps doing acquisitions outside of this circle. So they would have to broaden, right, their circle of competence. But this is where the expertise lies. Examples, for example, just to give you an example, a contrast between horizontal SaaS and vertical SaaS. Take a look at this. Salesforce is a very, very probably the best known. Also Microsoft 365, because what they have can be used across different industries. The same doesn't happen right here, right? Vertical SaaS, which makes it more difficult, in my opinion, to be disrupted. So Constellation uses a decentralized structure, which I absolutely adore, and let the acquired companies run on their own. They have 6 operating groups currently servicing customers in more than 150 different vertical markets worldwide. There are many VMS business units within each of its operating groups, blah, 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 blah. The centralized management structure allows the company to have business units management teams with strong customer relationships and deep market knowledge that are more focused and responsive than would be the case under a decentralized management model. Notice this thing right here, guys. They have deep relationships with their customers on top of understanding their needs, their problems very well. Do you think a cheap AI tool can disrupt that? I find that very hard to believe, okay? It's not just about doing things well, it's also about the expertise that you bring to the table, the ongoing maintenance that a lot of this software requires, and that is not easily replaceable. From time to time, CSU establishes what they consider to be an acceptable after-tax internal rate of return, which is like the hurdle rate for all their initiatives and acquisitions. Their business model is powerful yet simple to understand. Let me bold that, because this is actually the case, and this is what I love, right? Business models that are fairly simple to understand. They acquire a VMS company, they take the cash flows, they use those cash flows to acquire more companies in the space, and then rinse and repeat. And fast forward to today, Constellation owns over 1,400 of these VMS companies. Okay, typically they acquire VMS businesses with the following characteristics: growing business with a diversified customer base, high relative market share, and capital constrained competitors. Why am I pausing here? Because many people erroneously believe that they only acquire shitty companies because they trade below what they call fair value. That is not the case. They typically acquire good businesses, and if you go to the shareholder letters that Mark Leonard put out for years, he stopped doing that in 2016. But you can see that this is what they do. In fact, I think I can do that on the website, which I was exploring. Let me show you that right here. Constellation. Yes, yeah, it's on the website as well. So let's see. Constellation Software. Let me show you right here. If you come here to the investor relations, go here, not the president's letters, which are a gem, guys. If you really want to understand more about business and investing, please read his letters that were put out by Mark Leonard, and unfortunately stopped doing that in 2016, but they are solid. They are great, right? Where is that about us? Yeah, this being acquired. You come here, being acquired, and here you can see, you can read about their acquisition criteria. Look at that. Look. Let's see. While we are open to discussing, I think this is some. When we buy good company, whether they are selling for good reason, we buy good vertical market software companies. Now and again, we buy an exceptional company. So you see, most of the time they buy good companies. Every now and then they buy exceptional companies. Only rarely do they buy shitty companies. That said, let's go back to what I was discussing. At times, CCU may acquire VMS businesses with declining revenues, concentrated customer base, and low relative market share, right? But this is only done when management believes that the correct combination of customer relationship management and market segmentation will lead to attractive returns. And guys, let's pause for a second. do you actually think Constellation would be able to compound money at 30% per year over 20 years if they were buying only shitty businesses that didn't produce really any significant value? I find that hard to believe. Okay, I mean, it's mathematically impossible. Cool. So, historically, they have retained the majority of the managers from the businesses they have acquired, which has allowed them to retain the knowledge needed to manage and successfully build these businesses. And this is the revenue split. Look, something that I absolutely love. Most of the revenue is recurring by nature. This is very good because we love predictable revenue. Within revenue, this is the healthiest type of revenue that we can have, right? Recurring revenue. And you can split this into you can split this segment into two segments. One segment is subscriptions to use the software, right? A second segment is maintenance contracts that typically come with license sales, right? Because they have to provide ongoing maintenance to the software they provide. Cool. Then you see professional services revenue, about 20% of revenue. And you see license revenue in the hardware and other revenue. And sure enough, if you go to the revenue split on Fiscal AI, you can see what it looks like. One thing that I really like, take a look at this. Look at the blue bars right here. Look how the blue bars have grown significantly on right. They have grown a lot relative to the other ones over time. This means the blue bars is revenue from maintenance, right? Maintenance and other recurring revenue. This is exactly what we want to see because it means that now recurring revenue accounts more for the total revenue that the business produces, right? Which is something that I like to see. Exactly. And I stress that out right here, right? Notice how recurring revenue is becoming a bigger portion. Exactly. Look at maintenance slash recurring revenue as a percentage of revenue. This can be explained by the rise of SaaS typically paid on a subscription basis, and you pay as long as you want to use it, like a Netflix subscription, which is something that I also like a lot, right? So it ties into the recurring revenue that we were discussing. This is exactly what you want to see over time. In terms of geographical split, you can see that they generate 40% of the revenues in the US, another 40% in Europe and the UK, 10% from Canada. So we have a lot of we have a lot of how to say it, geographical dispersion. So the company is well diversified in that regard, which is good. Still, the majority of the revenues comes from Europe, UK, and in the US. Now, is management capable, right? So, bear with me 1 second. By the way, guys, look what I bought. Like a tortoise. Nice. Very nice. I want you guys to start buying this. I want to see, guys, right? I want you guys to send pictures. Okay, taking a breather here. All right, Mark Luna's outstanding capital allocation skills have earning the nickname of the Warren Buffett of software. But is this compensation? Yeah, we have to. This is another thing that I really loved reading, and I still have the report open. If I go here, so this is the website, right? But if I go here, and if you go to the report, this is the 2025 annual report. And if I go here to the annual report that they put out in March 31st, you can read about you can read about the compensation. So I was delving deeper into this, and look at that compensation here in that report. You can find this online. You can see how they detailed the compensation package and how they reward their executives. And I can tell you, and I knew this well before I started recording this, because as I said, Constellation Software has been on my radar for quite a while. And another thing that attracted me to this investment was the fact that they had one of the best compensation structures, right, that I have ever seen, and it's just absolutely mind-boggling, right? I think it should be used like for in every single company, fairly, in all fairness. So let me show you exactly what I have right here. Look at that. Constellation doesn't do quarterly calls, in case you guys didn't know. It's just like Warren Buffett, right? At Berkshire, following the same playbook as Berkshire Hathaway. Another impressive fact about Mike Leonard is his compensation. Since 2015, he has not taken any salary, stock, or bonuses, as he thinks his appreciation of Constellation stock is already enough. Okay? Here's what he wrote in his 2014 shareholder letter, which you can access once again on the website and go to the section called President Letters. I've been the president of Constellation Software for its first 20 years. I have waived all compensation because I don't want to work as hard in the future as I did during the last 20 years. Cutting my compensation will allow me to lead a more balanced life with a less oppressive sense of personal obligation. Look at that. I'm paying my own expenses for a different reason. I've traditionally traveled on economy tickets and stayed at modest hotels because I wasn't happy freeloading on the CSI shareholders. And I wanted to get a good example for the thousands of CSI employees who travel every single month. Oh my God. Guys, find me a founder who talks this way, who is just so, I mean, anyway, what else can I say? This tells us everything we need to know about his character. It's great. Oh, this is a typo. It's great to trust our money with exemplary management that treats us like partners, and this is exactly what I want as a long-term shareholder. I want to trust my money with people who take my best interests at heart. Okay, it's also great to see that the majority of CSI senior management's incentive compensation is linked to the profitability and growth of each VMS business unit's performance. The goal of this compensation plan is to reward employees for working towards the corporate goal of increasing shareholder value. They mentioned shareholder value many times in that 2025 report that I just showed you, which the SU believes is created by managing two financial components over long-term profitability and growth. As such, pay attention to this. Its bonus plan compensates employees at many levels of the organization based on the profitability and revenue growth of their operating group or business unit as applicable. The long-term focus is accomplished by mandating that at least 25% of the incentive compensation for the majority of its senior employees who earn in excess of 75k per annum and have bonuses in excess of 10k per annum be reinvested in shares of the company that are subject to restrictions on resale for a period of 3 to 10 years. At a minimum, these restrictions require employees to hold 100% of the shares for the first 2 years following acquisition, and then 1/3 of such shares may be sold in each of years 3, 4, and 5. Senior executives are required to invest 75% of their bonus in shares of the company that are subject to the same restrictions on resale for a period of 3 to 10 years. Once every 5 years, employees may elect to receive 100% of their bonus in cash, not shares in the company, because in Mark Leonard's mind, that will dilute existing shareholders, right? And you and I will see that's exactly why. That's exactly why, if I show you this right here on the income statement, and if you go to the diluted shares outstanding, that's exactly why since 2012, there hasn't been any change in the share count. They don't do buybacks because they use that cash flow to buy more companies, right? Acquisitions is their main expense, right? and they don't dilute existing shareholders. Yeah, they have no stock-based compensation. No stock-based compensation. So let's continue. May elect, okay. CSU bonus plan encourages employees to participate to share ownership in the value that they have created. Unfortunately, and this is definitely the case, Mark Leonard announced his resignation in early 2025 due to health issues. However, he will still be serving as a board member for the company. Mark Miller, former CEO, was appointed to take the CEO reins. And this is part of the reason we are seeing the stock coming under pressure as well, because ever since of this announcement, the stock has been selling off and it clashed with the AI fears as well. But what people fail to understand, because in all likelihood they didn't do any due diligence, is that this guy was the co-founder of the very first acquisition Constellation Software ever made, and he grew his branch of the Constellation tree in exemplary fashion over the subsequent 30 years. For 30 years, Mark Miller has been with Constellation Software. Do you think he understands the company and its business model hand over fist? I mean, excuse me, in this business model firsthand? Absolutely. You can see, in addition to that, something that I like reading, his background as a developer should give him extra depth and credibility to help the company navigate what it means to write and maintain software in an AI-enabled era. Because Mark Leonard didn't have a development background, right? So he was a finance guy. But this is where Mark Miller can add a lot of value to the company going forward, because not only does he understand now about deploying capital at high rates of return, right? But he also has a background in software development, so he understands how he can use AI to his advantage. And another thing that I want to flag is that Mark Leonard still holds 1.9% of Constellation Software. Okay, so we are talking about a lot of skin in the game here in an owner-operator stock. Oh, and Mark Miller also owns roughly 700 million worth of CCI shares, having even purchased more shares on the open market after Mark Leonard's resignation. And if I come here, right, to our stock unlock platform, and if I show you insiders, go here to insider transactions, take a look at this. Look at the amount of insider buying over the last several months, and sure enough, you can see that Mark Miller was buying stock in December 2025. More recently, this chief investment officer was also scooping up shares. Okay. And if I go here to our ownership, you can see that Mark Leonard owns almost 100 billion worth of stock. So a lot of skin in the game. And I also wanted to buy a company with a lot of skin in the game. Fantastic. Let's move on. Okay. Also, something that I love doing, guys, I went to Comparably, where you can see information about the company's culture, and you can see that he gets an overall score of 74, right? Which is his approval rate is just above average, putting Mark in the top 40% of all CEOs of similar sized companies on Comparably. However, you can see that this was only out of 36 Constellation Software employee reviews. And so, because it's not really a sizable sample, I went to Glassdoor. And on Glassdoor, you can see something very different. We can see that CSU gets an overall score of 4.1 based on 151 total reviews, which is well above the average of 3.5 out of 5, and highlights its great culture. In addition, take a look at this. It's also great to see that about 93% of employees approve of the CEO. This is fantastic. Exactly what we want to see. And now, We move on to, does the company have a sustainable competitive advantage? And sure enough, look what Mark Leonard had to say about competitive advantage in one of his shareholder letters. The barrier to starting a conglomerate of vertical market software businesses is pretty much a checkbook and a telephone. This makes you believe that he believes the company does not have any moat. But this is where I think Mark Leonard is underselling himself in this company. It may sound simple to replicate the business model, and there have been many copycats over the years, but the difficulty is in the successful execution. Not every company has managed to do what Constellation has achieved. So yes, I do think they have a competitive advantage, but its moat is built on process discipline, decentralized culture, and an unmatched acquisition engine rather than brand power or technological dominance. Here's a structured view. So acquisition engine and scale, right? This is a wide moat in my opinion. So I detailed all of that, where they focus on tiny mission critical software businesses that are often ignored by private equity because they are so small, and they operate in a deal universe with limited competition, which allows them to keep purchasing multiples low, and that's why they can demand a 20% hurdle rate, right? Like me, they want to have very nice returns on their investments. Cool. So, and look at that, vertical market software focus on switching costs mode. SCU targets niche industry specific software. This is software for local government, utilities, healthcare, logistics, very, very niche. These products are deeply embedded in customers' daily operations. You see how hard it is for AI to disrupt this. Switching costs are high because of what? Software is mission critical but low as a percentage of customer budgets. Replacements are risky. Even if there were a tool capable of replacing the software, they I mean there are risks that are involved with that replacement, right? Because you would have to train your employees on the new systems, and that creates a lot of risk in the case they don't understand it, right? It may take time. So, and they cannot function without the software. So customers often lack credible alternatives. This results in sticky recurring revenues, low churn, and strong pricing power over time. Cool. Decentralized culture and incentive design. Intangible. Bear with me as my dog is just scratching the door. Okay, sorry about that. Cool. So decentralized culture and incentive design. Constellation operates with extreme decentralization. I think this is part of their competitive edge because they have managed to operate under so much decentralization successfully over a very long period of time. And just take a look what that means, guys. The head office has fewer than 20 people, while the company owns over 1,000 businesses. I mean, what the heck? This is absolutely incredible. And what it leads to is something that you can see right here in this image. Look at that. Here is a snapshot of all the companies under their belt, a perfect constellation of VMS companies. Absolutely incredible. Okay, so this is where I discuss business units retain autonomy, local leadership, and entrepreneurial control. All of this is essential. Very nice capital allocation discipline. Constellation is arguably one of the best serial acquirers in the world, certainly in public markets as well. And so here we go. This is the hurdle rate between 20-25%. So those guys they are very strict with that hurdle rate, and they don't buy a company if they don't think the hurdle rate meets their requirements. It needs to meet that criteria. So here we go. Financial strength and resilience. Of course, we will talk more about that going forward, but they have a very good balance sheet, no financial distress. Preferred buyer status and seller of trust. How important is that, guys? I mean, if you are a business owner of in one of the, so if you are one of these business owners, right, would you want to sell your baby to any single company? Of course not. And this is exactly what Constellation Software offers. They have built such a reputation over decades as the preferred acquirer of vertical market software businesses. So when companies are looking to sell, of course, they would love to sell to Constellation Software, and not least because Constellation Software allows the business owners to remain at the helm of the company, so they are allowed to make a lot of decisions, right? Because of that decentralized structure. The decision to sell is rarely about maximizing price alone. You can see preserving jobs and autonomy. They have their autonomy, which is awesome. Why founders prefer Constellation? Permanent ownership, right? They are a long-term owner, not a 5 to 7 year flipper. In fact, I think on average they stay with these companies for decades, which is incredible. Acquired businesses are never sold unless under exceptional circumstances, right? So only once historically, and this was a decision Mark Leonard openly regrets. So, of course, so here's one more reason for the pickiness, right? Because they are very cautious about what companies they are buying because of that. Um, Aligned incentives, cultural fit. This reputation feeds future deal flow. Founders talk to each other. Advisors learn who the good buyer is, and Constellation increasingly sees proprietary of market opportunities. This creates a self-reinforcing acquisition mode, right? Last but not least, most of the underlying VMS businesses' hidden strength. Uh, yeah, this is forgot this. Okay, limited competition, small total addressable market, high switching costs. This is already within the VMS structure. High switching costs, mission critical, not optional, right? Trust, customization, and first mover advantage. As Mark Leonard puts it, vertical market software is the distillation of a conversation between the vendor and the customer that has gone on frequently for a couple of decades. And look what I found, guys. If you look at the, if you look right here, where did this come from? I highlighted this and I forgot to mention it here. This is from one of their this is from one of the of this is from one of Mark Leonard's newsletters. Newsletters to shareholders. I just don't recall the name. Historically, Constellation raised prices by 5% per year, well above inflation, a clear signal of pricing power. Sure enough, if I zoom in on this, look at that. Since 2007 all the way to 2026, yes, this you can have access to this again on the website. Go to Mark Leonard's 2016 newsletter to shareholders, right? And you can see that price increases in order over time. So they do have pricing power exactly because the software is sticky, right? And it needs ongoing maintenance. Exactly, cool. So then we have the conclusion right here. And now, is the company active in an attractive end markets? Yes, it is indeed active in attractive end markets, but not in the way investors. Nah. So it is a structural review. Vertical market software is structurally attractive, right? And for these reasons, it's small, overlooked markets by design. So each individual VMS market has a small total addressable market, limited incentive for large software vendors to enter, so few well-funded competitors. This lack of attention is precisely what makes them attractive. In effect, CCU operates across hundreds of micro markets, reducing dependency on any single industry or geography. And this is very important, guys, because, for example, as you know, because they own so many vertical market software companies, even if AI disrupts one or two of them, it's hardly going to make a dent in the overall revenue because they are well diversified, right? And they operate across different sectors and industries, which is something that I love. Fragmentation creates a long runway, right? Extremely fragmented, full of founder-owned businesses, largely underpenetrated by institutional capital. This provides Constellation with a long acquisition runway, even at its current scale. Like that. I like that a lot. So, what are the main risks for the company? Low organic growth is one of them. Look, vertical market software businesses are not high growth by nature. So, I didn't buy Constellation Software because I was hoping they would grow the organic growth over time. No, the core of their business model, right, what they do, what they are very good at, is acquisitions. I expect them to continue to do that over the next few years. Um, and so organic growth is constrained to price increases, upselling adjacent modules, minor market share gains. Taking significant share from competitors is difficult because customers are sticky. Competitors often enjoy the same switching cost advantages. You can see that historically, total organic growth, including recurring revenue, has averaged 2 to 3%, roughly in line with inflation. While organic growth has improved in recent years, right? CSU will never be an organic growth story. And if I show you this right here, here we go. You have your 2% on average. Look at total organic growth, right? About 2%. This goes back all the way to 2012. Okay. Whew. Let me take another sip. Dependence on the acquisition engine, execution risk. So Constellation's success relies on its ability to source a steady pipeline of high quality VMS targets. If acquire them at reasonable multiples, reinvest capital at high incremental ROIs. So if any of the above weaken, returns of course will suffer. Key risks include rising competition from private equity in VMS, which, as we already discussed, is not meaningful. Higher acquisition multiples compressing returns. We will talk more about that as well. Diminishing availability of suitable targets over time. Although the VMS universe remains fragmented, the model scalability is not infinite. Law of large numbers and declining marginal returns, structural reality. Why is this important? I want you guys to pay close attention to this. As Constellation grows, maintaining historical reinvestment rates becomes mathematically harder. Look no further than Berkshire Hathaway. Berkshire Hathaway used to grow at 20, sometimes 30% per year over decades. The reason they cannot do that anymore is because they have grown into such a large company. It's very difficult for them to find companies that move the needle, right? So every year, more capital must be deployed just to stand still. The pool of perfect fit, right? Their acquisition targets are 2 to 5 million acquisitions, right? Becomes relatively smaller. CSU is increasingly forced to pursue larger investments. Implications of larger deals. Larger acquisitions tend to be more competitive, right? It makes because if you buy companies that are larger, then of course competition is going to be greater as well. More people are pursuing those deals. Entry multiples then are higher because those business owners can demand a higher multiple for the company because of competition. Integration risk increases, returns are structurally lower, of course, for the one buying them. Recognizing this, Constellation Software applies lower hurdle rates to larger deals, accepts lower incremental ROIs in exchange for deployability. This is rational, however, it caps long-term return potential. What does that mean? It means that I no longer expect the company to grow at 30% per year. And we don't need that to achieve phenomenal returns on our investment. Okay? So look at that. This visual shows that returns tend to come down as serial acquirers become larger. Look at that. Cool. And I got this from Canuck Analyst, so I can just click here and just look at it. But if I click here, then this will lead me to that page. And it's a very nice, compelling report that was put out. I was reading it early this morning. And yeah, well, I mean, it's another source of information, which is always welcome. Well, I don't know why it's not opening right now, but anyway, let's continue right here. Okay, bear with me 1 second. Uh, Bear with me 1 second as I open it. Right here. So as you guys well know, I like to do to again to have a look at put all my main metrics together, and this is what you can see right here. So I got those numbers right here. Look at the margins, look at the capital intensity, the solvency metrics, my valuation process, right? Fieldtown valuation metrics, the returns on capital, the valuation ratios, all of that is necessary, and these are the metrics that I used right here. Cool. So let's move on. Interest coverage ratio is at about 7. Right off the bat, you can see that this is quite small, but you have to understand the business model. This is what I always tell you. So if I didn't know Constellation Software, I would tell you that interest coverage ratio of 7 is quite low because you are doing the EBIT, so the operating income divided by the interest expense. And it will be lower because you have to use adjusted EBITDA, right? Because remember, they are a serial acquirer, and because of that, their operating profit looks lower than it actually is, right? They buy so many companies, they have massive non-cash amortization charges, which punishes the reported operating profit, even though the cash is still in the bank. So if I show you the financials, let's go here to the financials. And if I show you the cash flow statement, you can see that only amortization stand at about well over 1 billion. Of course, that's what they do. They acquire businesses, and this is an non-cash expense that is added to the operating cash flows. But of course, it because it's not excluded from operating, because it's not excluded from the earnings before interest and tax, right? It gives you a very depressed number. Cool. So let's continue, and that's why I use EBITDA instead. Earnings before interest, taxes, and amortization, which removes the acquisition-related accounting noise. And if you do that, this is how much you get, right? You get about 3 billion, where the operating income currently stands at. Let's have a look. About slightly under 2 billion. So you can see there is a massive difference. And when you do the math, you get about 12.19, which is well above our preferred 8 thresholds. Okay, very good. Now, current ratio 1. This is good, right? It means that a current ratio of 1 means CSU current assets are just above the same, are just about the same as current liabilities. That said, it's important to understand that low current ratios are common in companies with high operating efficiency and strong cash conversion cycles, and that is certainly the case for this company, right? Because of these predictable recurring cash flows and all of that. Debt to equity, I like to see this under 3, which means the company only uses moderate leverage, well supported by stable recurring cash flows. Okay, debt to free cash flow under 3, again, that is ideal because the company can pay down all of its debt within less than 3 years of current free cash flow. Exactly what we want. In last but not least, debt. Oh, we still have goodwill. Debt to earnings is just 10.92 right off the bat. This is a big red flag. However, remember, earnings are depressed because amortization is factored in. We don't want that to happen because they are a serial acquirer. So instead of using earnings as we normally do, right, we would be using EBITDA. And if you do EBITDA, then you will get 1.73, which is exactly what we want, our preferred threshold, under 3. What's staggering is that even though they are a serial acquirer, goodwill as a percentage of total assets sits at about 11%. That is low, guys, and it reflects what disciplined acquisition pricing and preference for small founder-led deals. Okay, so very good right here. Does the company need a lot of capital to operate? And the answer is absolutely no. To give you context, ideally, I prefer capex as a percentage of sales to be under 5%, and capex as a percentage of operating cash flow to be 15%, and that is definitely the case. Capex is important because under the scenario that VMH companies had high capital requirements, the cash generation would be limited, and cash is what fuels the M&A engine, not profits. Fortunately, that capex is quite low, as we already determined. And so, yeah, they don't require heavy investments to sustain its operations. It's a capital-light business model that prioritizes acquisitions once again. All right. Is the company a great capital allocator? We arrive at our most important metric in our opinion, and that is ROIC. Remember, guys, how ROIC is calculated because we're going to have to adjust it. All right. Capital allocation is management's most important job, right? Over long period, shareholder returns are driven less by operating results and more by how effectively free cash flow is reinvested. Constellation is built around this principle, and Mark Leonard puts it over the very long term. Stock returns will be determined largely by which capital allocation decisions the CEO makes. Oh my God, this is exactly what I want from a CEO. Even though he's passing the baton, this is the culture that he has built over time, and I just love this. These guys are in with our interests at heart. Trust me. I always target a ROIC above 15%, as you guys know. Traditional ROIC calculations, right? So we do NOPAT divided by invested capital, but this, of course, understates Constellation through economics because accounting profits are heavily distorted by acquisition related amortization. And so, how can we mitigate that? Instead of using net operating profits after tax, the only thing I want you to do is to use EBITDA. You will do EBIT divided by invested capital, and that will give you an adjusted ROIC of about 26.8%. Yeah, the alternative to that, which is something that I didn't do here, is you can do NOPAT, but you're going to have to divide NOPAT and then you're going to have to adjust the invested capital. What I also do, you can do total equity plus total debt minus cash and cash equivalents minus goodwill. You want to make sure that you strip out goodwill. Otherwise, I mean, otherwise invested capital will be too high and that will depress ROIC, which is not what you want. Okay, but you can use that right here, and you can see that I went to the 2017 was it report? I think it was annual report. Excuse me, the Mark Leonard disclosed in his 2018 shareholder letter, and you can see that this is what you have, and our ROIC of 26.8 is well in line with past ROICs as well, right? In 2017, for example, it was at 29%, but for example, in 2010, it was 26%. So, I mean, I like that. The company still remains a very good capital operator. And look at that. Most serial acquirers see ROIC decline materially as they scale. That is not the case with Constellation Software. All right. Though they are definitely the exception to the rule. High ROIC only matters if capital can be reinvested at scale. And so, unlike many acquirers, Constellation has explicitly prioritized reinvestments over payouts. In his 2001, Mark Leonard laid out two realistic paths to maintain reinvestment rates: larger VMS acquisitions, expanding beyond VMS. Leonard has been explicit about the consequences if we are successful in acquiring one or two large VMS businesses per annum. Then I anticipate that Constellation Software return on investors' capital will decrease. I mean, I love how transparent he is, how honest he is, right? But and as you can see, what he's saying is true because there is a strong historical correlation between valuation multiples and average deal size, as you can see right here. Again, I got that from this report right here. But you can see that because by this, look at this. So where is it? Because VMS markets are small and niche, operators often know potential targets better than any central EMA team ever could. By decentralizing capital allocation, Constellation Software found a way to keep doing small, higher return acquisitions, and that's why Constellation Software is the clear exception to the rule, guys. Right? Which is, I mean, it's just fantastic. Also, you can have a look at the economic spread. You do the ROIs, which is 26.8%, minus 7.60, which is their cost of capital, and that gives you about 19.2%, which is absolutely staggering. What the hell does that mean, if you are asking? I have laid that out here. The economic spread measures how much value a company is creating relative to its cost of funding. This means CSU spread sits at 19.2%, which means the company earns a lot more on its investor capital than it costs to finance it. Okay, which is staggering. How profitable is the company? I also disclose that right here. You can see all the profitability metrics right here. We will just focus on the operating margin, right, which is the net profit margin is low, again, because net income is not adequate, but I just lay that out here. So you have to use EBITDA margin instead, which is at 28.7%, and the operating margin is very attractive as well. Gross margin is high, because it reflects the nature of the business model. Vertical market software has minimal incremental delivery costs, no inventory, and no physical inputs, because most costs are operating, right? R&D, sales, and admin, and of course, acquisition-related amortization and integration. That's why you see a very high gross margin right here. And despite inflationary pressures and all of that, they still maintain very solid operating margins, which demonstrates strong cost discipline, decentralized operational efficiency, and the ability to invest for growth without sacrificing profitability. Okay, and then we arrive at EBIT margin, where you get 28%, which is very, very good. This is far more representative measure, right, of operating performance. It means that this places Constellation among the most profitable software businesses globally, especially considering its decentralized structure and conservative accounting. Last but not least, you have a free cash flow margin of about 28%, which means they effectively convert 28% of revenue into pure free cash flow, right? And look at the average figure. So this figure has averaged 22.25%. It has actually gone up over time, right? And these margins are incredible, and they are driven primarily by recurring maintenance revenue. Yeah, and this segment, as we discussed, has been growing over time. Minimal capital expenditures, negative or neutral working capital dynamics, low reinvestment needs at operating level. Absolutely amazing. They are not just profitable, they are a cash compounding machine. And does the company use a lot of stock-based compensation? I will keep it short. They have zero stock-based compensation. Who doesn't love that, right? The share count has remained exactly the same for over a decade, which is fantastic. And this is exactly what we want to see. This is the closest thing to perfection. Let me bold that. Since management is rewarded for performance and shareholders are not diluted. I love that. In addition, you can see that the company has grown very attractively in the past as well. Look how these metrics have all improved. Look, free cash flow has improved, right, from a 10-year average to a 3-year average, and so did revenue. And the only thing that it declined, and it's not accurate, as we discussed, is the earnings per share. So look at this, absolutely outstanding. I took this from Stock and Lock, and it's very, very good. Okay, the maturity. So I don't want to spend too much time right here. Only here, free cash flow per share is the most relevant growth metric for CCU. Okay. The most remarkable consistency in translating revenue growth into shareholder value. This reinforces the strength of its capital allocation model and its ability to compound value over time. In addition, look what the outlook looks like. So analysts are projecting earnings per share long-term growth estimates around 17.7%, and revenue forward 2 years is about 16%, which is fantastic. And now we arrive at the last segment of our report. And thank you so much again for staying around so far. For this business, guys, I used Philtown's two valuation methods, payback time and 10 cap rate, which I will discuss by going right here. And if we do this right, so here we go. This is our sheet right here. The 10 cap rate. So the payback time we use as free cash flow, and ideally we want to recoup our investment within 8 years, right, of current free cash flows. So we already have a 50% margin of safety built in here, and if you do that, right, this is free cash flow, current free cash flow. Then we grow that at 15%. We get this cumulative free cash flow, which we then divide by the number of outstanding shares, and we get a free cash flow year 8 year payback time price of about 2K, with the stock currently trading at 1781. What does that mean? It means, ladies and gentlemen, that it meets our criteria, right? So we have a margin of safety using the payback time right here. The 10 cap rate gives us about $1,400 a share, which is a bit below these levels that we are trading at right now. But I used a payback time, and this is why I bought the stock, because it was actually under this level right here. But sure enough, we will also do the reverse DCF very quickly for you guys to see. And you can see that if we assume a projected growth rate of about 11% over the next 10 years, what is the price we should pay for shares? And that is about 1,736. So the question you have to ask yourself is, do I think the company can grow at 11% per year over the next 10 years? Bear in mind, analysts are projecting around 17%. I'm more optimistic because I'm assuming, for example, 15%, but at current levels, you can see that the growth is around 11% built in, and I do think that Constellation can go on to meet these conservative expectations. Okay, whew, guys, this has been absolutely outstanding. It was awesome. I really love doing this, and I do hope that you managed to find a ton of value. The last question is, should we invest in the company? And of course, the answer is yes. We did invest in the company, and that's it. And so, always, I mean, we put our money where our mouth is. Thank you so much for watching this